Hello everyone, this is Ridhima Bhatia, and today we are discussing the hot topic, which is Union Budget 2022 and 2023. So the Union Budget has proposed lots of pandemics related concerns and have obviously made the growth trajectory into a futuristic and inclusive development. So we will begin with something which everyone seeks to understand and know and are very keen to know if there are any changes. Yes, you are right. We are talking about income tax rates. So as you all know, there has been no change in the income tax rate again for this year, which is our assessment year 2023 and 2024. However, having said that, there are certain changes in the surcharge of certain categories like LTCG on general transfer of assets, and then we have a change in certain surcharge for cooperative societies and specified AOPs. So let's just quickly recap and refresh our understanding and our knowledge of tax rate, and we'll go through quickly on our changes. So as I just told that there has been no change in the tax rates for the assessment year 2023-2024. But yes, there are certain changes in surcharge. But what are the tax rates now? So as you can see on the screen, there are certain categorization of tax rates where individuals, HUF, AOP, BOIs are taxed on a progressive rate, which is more the income, more the tax. And whereas companies, firms, local authorities are taxed at flat rates. So what are the rates for individual or HUF? So here you can see in our column, this is individual or HUF opting for normal tax regime. What is normal tax regime? So dear students, some 2 years back, an alternate tax regime was also introduced where for giving certain benefits, you can choose to get taxed at a lower rate. But what you have to see is that you are foregoing certain benefits. We'll not go into the details of those, but yes, we'll quickly give a look to the comparison of a normal tax regime and the alternate tax regime. So the normal tax regime for individuals and HUF have the basic exemption limit of 2,50,000 for other than senior citizens and super senior citizens. So senior citizens have the basic exemption limit of 3 lakhs, whereas super senior citizens who are more than 80 years, who are 80 years or more of the age, have the basic exemption limit of 5 lakh. That means that their this much income, which is 2,50,000, 3 lakh or 5 lakh, as the case may be, will not be charged to tax. But again, as we move ahead on the slabs, we see that the income between 2,50,000 to 5 lakhs would be taxed at 5%. From 5 lakhs to 10 lakhs would be taxed at 20%, and above 10 lakhs would be taxed at 30% in individuals of and HUF in general scenarios. So you can see the diagonal tables covering the exact rates. But senior citizens have a different slab because of their basic exemption limit being slightly higher than the other individuals. Their basic exemption limit goes to 3 lakh, and hence their slab rate becomes 3 lakhs to 5 lakhs at 5%, 5 lakh to 10 lakh at 20%, and above 10 lakh at 30%. And super senior citizens who are, yes, again 80 years or more, will be taxed at nothing up to 5 lakhs, 5 lakh to 10 lakh at 20%, and above 10 lakh at 30%. So there is no change in, even if there's a comparison table, but you'll see there are no change in the tax rate for individuals or HUF. But individuals or HUF who are following the alternate tax regime, which is provided under section 115 BAC, you see these slab rates are more defined, and the rates which generally go 30% in above 10 lakhs in normal tax regime is here in the alternate tax regime for an income above 15 lakhs. But this is not a very lucrative scheme because yes, you have to forego your deductions benefits, your housing loan interest benefits if you have a self-occupied property, your many other additional depreciation benefits if you're into a manufacturing business. So once you opt for such schemes, you have to be very thoughtful in your tax planning if you have to opt such scheme. So quickly going to the alternate tax regime, which is applicable on individuals or HUF. Up to 2,50,000, there is no tax. 2,50,000 to 5 lakhs at 5%. 5 lakh above to 7,50,000 at 10%. 7,50,000 to rupees 10 lakh at 15%. 10 lakh above to 12,50,000 at 20%. 12,50,000 above to 15 lakh at 25%. And above 15 lakh at 30%. So for every increase of 2,50,000, there's an increase in 5% tax rate. Again, no change between the 2 years. Students, one thing you have to see that once we talk about tax, tax is not only the part which you pay to the government. There is tax, there is surcharge. On that tax and surcharge, there is cess which is added on. So those all elements in total becomes our total tax liability. But with these additions to the tax, there is also a concept called rebate. Rebate, which is provided under Section 87A of the income tax only to the resident individuals if their total taxable income is up to 5 lakhs. Is up to 5 lakhs. How much rebate is given? Whatever your tax comes, or 12,500, whichever is low. Tax rates for AOP BOI is something similar to what is there for individuals or HUF in a normal tax regime. So I hope this is clear. Now coming to the company. So again, there is an alternate tax regime under various sections for domestic companies. So domestic company can either choose to get taxed under Section 115BAB, in which their income is taxed at a special rate of 15%. Is taxed at a special rate of 15%, provided that is coming from their manufacturing business. So again, this scheme was for incentivizing the manufacturing company or to grow Make in India so that there is more domestic scale manufacturing. So their income is taxed at a very attractive rate of 15%. Non-manufacturing income, so whatever they are having from other activities, would be taxed at 20%. If they are having any short-term capital gains from transfer of the assets which are used in business, it could be 15%. If they're having any short-term capital gains from transfer of the assets which are not used in business but are capital assets, 20%, 22%. If they are making any type of mischievous changes due to which the assessing officer actually get hold of it and made an addition into your profits. So if I say by an example, let's say you know that you are to be charged at a very attractive lower rate, which is 15%, right? So you show your profits at a higher rate so that other company can show their expenses at a high rate. So income of one is an expense for other. So in that case, you are giving a benefit to the other company so that, okay, I claim, I issue a bill at a higher price. So that you can claim an expenditure at that higher price. You will get a profit. You'll get a benefit basically by showing excess expenditure, and I in any way is charged at a very attractive rate of 15%. So it would be a win-win situation. The assessing officer gets to see that you are into such mischievous planning. So what they do, they see whatever excess profit you are showing. So instead of 10 lakhs per bill, you issue a sale bill of 15 lakhs so that that person can get a deduction of 15 lakhs. So whatever excess of 5 lakhs you are showing would be taxed at 30%. And any other special income which are there in chapter 12 would be taxed at the rates which are there. Again, there has been no change in the rates for our assessment year 22-23 and assessment year 23-24, which is discussed by the budget. But if you're not opting for this special or alternate tax scheme under section 115 BAB, you will be charged at the normal flat rates. Again, the normal flat rate are 25%. If your turnover for the previous year 2021 does not exceed 400 crore, then you will be charged at 25% for the assessment year 23-24. There are other optional tax schemes under section 115 DA and 115 BAA. These are again for our domestic companies, which again gives a lower rate of 25% and 22%. So if you are any other domestic company not falling in any of the categories above, not opting for the alternate tax schemes, so if you are a company into service sector having a turnover of say 700 crores, then you would be charged at a 30% flat rate. So profits, your income would be charged at flat 30%. And if you're a foreign company, it would be taxed at 40%. Tax rate for cooperative societies, any entities who are taxed as an entity of cooperative society, again have two types of tax regime. One is an alternate one, which is covered under section 115 BAB at a flat rate of 22%, but again on fulfilling certain conditions. Another is slab rates, which is like up to 10,000, 10%, 10,001 to 20,000, 20%, and above 20,000, 30%. Tax rate for other entities like firm, partnership firms, and LLPs, limited liability partnerships, are taxed at 30%, and local authorities are taxed at 30% again. So again, your friends, there have been no change in the income tax rate, either in alternate tax regime or in the normal tax regime for whatsoever assessee is. But yes, there has been certain change in surcharge. So as I told you, on the total income, there is an addition which is called surcharge, So if you are into income earning higher, into a higher income group, so the government says that over and above the tax, you will give an extra amount as surcharge. So surcharge in case of individuals, HUF, AOP is also almost same, but yes, there has been certain change when we talk about AOPs, in who all the members, AOP in who all the members are company. Or if we talk about long-term capital gains covered under section 112, or we talk about cooperative societies not opting section 115 BAD. So let's quickly go through it. What is this all about? So first, step by step again, the rate of surcharge in the hands of individuals, HUF, AOP, is as follow. Again, students, what we have is that our income is divided under various types, under 5 types of head. One being salary, house, property. We have business income, then we have capital gain, and whatever does not classify in all the above head goes to a residuary head, which is other income. But there are certain income which are taxed at special rate, is one thing, but there are certain incomes who are taxed at special rate but also has a special surcharge to it. So the special surcharge or the specific surcharge to such special incomes are short-term capital gain covered under 111A, which is again sale of equity shares or equity-oriented units through recognized stock exchange. They have the maximum capped surcharge at 15%. I'll come to it. Then long-term capital gains, again, covered under 112A, which is sale of, again, equity shares, equity-oriented funds through recognized stock exchange, is the maximum surcharge capped at 15%. So is with dividend income, which gets taxed from the last year. What is the difference. So what has happened is, when the surcharge was introduced with more the income, more the tax, and similarly more the income, more the tax, and more the surcharge, a higher surcharge rate of 37% was introduced. But the capping was done to certain income, that the surcharge on the tax of certain incomes would not be more than 15%. So in general, if you see the last column, the surcharge is 10% when you earn more than 50 lakhs, but up to 1 crore, which is your taxable income is more than 50 lakhs or up to 1 crore. Then the surcharge is 10% of the tax amount. If you earn more than 1 crore to 2 crore, the surcharge is 15% of the tax amount. If you earn more, or your income is more than 2 crore, but up to 5 crore, it is 25%. And if your income is more than 5 crore, it is 37%. But if you're having these special incomes, the maximum surcharge would be 15%. So where the surcharge is less than 15%, it would be 10%. But where the surcharge rates are more than 15%, it would be maximum to 15%. So for the short-term capital gain 111A, short-term capital, long-term capital gain 112A, dividend income, all are taxed at maximum 15%. So if someone says the surcharge is capped at 15%, that means where the lower rate is applicable, lower would be applicable. Otherwise, 15% would be highest. So what is the change in this? So from this year, the proposal has made, that is from assessment year 23-24, the proposal has been made to tax our for the surcharge at the long-term capital gains covered under section 112, which is the general taxing section for the transfers of capital assets which are in the nature of long-term assets. So on equity oriented or equity shares, you are taxed under 112A. Otherwise, your long-term capital gain goes in section 112. So in that, the flat rate is 20% for the tax, and the surcharge here also is capped to 15%. Earlier, that was matching to our general rate surcharge, but from the proposal made in this year union budget, it would be maximum 15%. So where the surcharge was higher of 15%, it would be capped to 15%. So if you are having a long-term capital gain of more than 2 crore on transfer of an asset, say building, you would be taxed at 20%, and the surcharge at it would be 15%. Correct? So with this, we'll illustrate quickly an example. So if you can see on the screen, a quick example has been done. So LTCG on sale of shares under section 112A, a person, say Mr. X, has the long-term capital gain of 2 crores on sale of shares, long-term capital gain on transfer of building, which is taxed under section 112 at of rupees 4 crore, other income of 2.5 crores. So the tax on this is 10%, but with exemption of 1 lakh. Tax on this income is 20%, but is 20%, and tax on this income is as per slab rate. So if you calculate it, you will get these amount respectively. Now the surcharge. Now, until last year or this assessment year 22-23, you were calculating surcharge at this income capped at 15%, because obviously the income is in the total income is in 8.5 crore. But since the long-term capital gain under section 112A was capped for a surcharge of 15%, whatever tax comes here, you're adding a surcharge of 15% only here. Okay. And these two income was seen in clubbing to see what rate of surcharge was applicable. So 4 crore plus 2.5 crore is 6.5 crore. 6.5 crore means that my income is here more than 5 crore, which makes my surcharge rate to be 37%. The tax on these income in totality were surcharged at 37%. Clear? This was the scenario for assessment year 22-23, which was before the budget was introduced. Now, if you see on total tax plus total surcharge, you pay an education cess, and basically on an income of 8.5 crores, you're paying close to 2.5 crores as tax or 2.4 crore as tax. Now, with the change which is introduced in the Union Budget 2022-2023, what has happened is they have capped the surcharge of 112 just like 112A at 15%. So if now here you have calculated the tax up till this point where there has been no change at all. Special rates are as applicable as such, 10% on an exemption of 1 lakh, 20%, and the slab rates. So while we calculate it, now we calculate the surcharge. Again, here the surcharge is capped at 15%. You calculated 15%, just like the one in the previous year. Here now the surcharge is also capped at 15%. The income is more than 1 crore, so it would be capped at 15%. So surcharge is 15% of the tax amount. And on the other income, now on the other income, how much would be the surcharge? 37, 25, 15. Now, since the other income is only 2.5 crore, which is this, so on the other income, now the surcharge would be taxed at 25%, not 37%. So you will get, if you see, close to 27 lakhs ka net benefit in your taxes. Why? Because one, obviously they have capped the limit of 15% on the surcharge of long-term capital gain under section 112, but with the impact of it, my other income also get reduced because now other income has only the parts except 112A, 112 and 111A, and also dividend income. So you can give a look to the working and have an understanding that how reducing this or with this impact you'll be having. If you have a good amount of capital gains, you'll be having or you'll be enjoying great benefits of tax savings. Now, the rate of surcharge on those assessees who have flat rates and cooperative societies are as follow. Again, there has been no change in the rates. The rate goes as from local authority where the tax rate is 30%, the surcharge rate is 12% only if your income is more than 1 crore. For domestic company, the surcharge is 10% irrespective of your income, because if you are getting taxed in an alternate tax regime under section 115 BAA or 115 BAB. The domestic companies who are taxed at 25% or 30% based on their turnovers will have a surcharge of 7% if their income is more than 1 crore or 12% if their income is more than 10 crore. So 1 crore to 10 crore if you have an income, then 7%. If your income is more than 10 crore, then it would be 12%. Foreign companies having a flat rate of 40% has to pay surcharge of 2% if the income is more than 1 crore but up to 10 crore. And if their income is more than 10 crore, the surcharge is 5%. Cooperative societies, again, opting for a special regime or the alternate tax regime under section 115 BAT are taxed at 22%, and the surcharge is 10% irrespective of the level of income. And the cooperative societies who follow the slab system of 10,000 up to 10,000, 10%, 10,001 to 20,000, 20%, above 30,000, 30% has to pay surcharge only when their income crosses 1 crore. But here is what the change is. Earlier, there was a surcharge of 12% when the income crossed 1 crore. But now, if the income crosses 1 crore but is up to 10 crore, the surcharge is 7%. But if income is more than 10 crores, the surcharge is 12%. So, on all this tax and surcharges in aggregate and health and education cess is applicable across assessees, irrespective of the regime they follow, at a rate of 4%. So with this, we wrap up our understanding of tax rates, surcharges, and the changes made by the Union Budget 2022-2023. For more to follow, please log on to Taxmann. Thank you.